Hello, good evening, everyone, and welcome to the webinar organized by Online Traders Club Singapore. My name is Richard, and I'm your host today. And if you are here for the very first time, please join our OTCS Telegram channel by searching for Online Traders Club in Telegram so that you can be kept posted of our upcoming events. All right. So without further ado, let me now go on to introduce the club to you. Okay, Online Traders Club Singapore, or OTCS, is a non-profit society set up in 2005, and we are a community of traders and investors here in Singapore. To me, OTCS stands for a place where we network, share, and learn, and we do it through a series of workshops and webinars and courses and our library. For workshops and webinars, we aim to have about about 10 to 12 a year, but because of COVID, so we may have adjusted this number down to a little less frequent, and it is for free for our members to attend. But ever since COVID, we have gone entirely online, and it is free for everyone to attend. So it looks like COVID is finally coming to a critical juncture. So maybe physical events could be happening again in 2023. So let's look forward to that. Now, this photo was one of our last major event that was conducted in January of 2020, just before the COVID situation blew up. So we are glad to say that we look forward to holding events like this again, hopefully in the coming year or so. Okay. As for courses, we aim to have about 3 to 6 a year, and we normally will do a group buy deal with trainers and course providers so that our members can enjoy a discount for the courses. As for the library, we have over $6,000 worth of resources, and it is a physical library. However, because of COVID situation, the library is closed at the moment. But if you would like to find out what are the titles that we have, you can download the PDF on our website. So again, OTCS is a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. And the normal price for membership is 120 Singapore dollars a year. However, for a limited time, it is $60 a year. And currently, because of the COVID situation, it is entirely free. So if you'd like to find out what our club is about, please visit onlinetradersclub.org. Okay, so in case you just join us in the webinar, please join our Telegram channel by searching for Online Traders Club in Telegram so that you can be kept posted of our upcoming events. Alternatively, if you prefer to receive email, you can also join our mailing list by looking for the mailing list link on our website. At this juncture, I'd like to give a shout out to our OTCS crew, our friends and fellow members in OTCS who help us behind the scenes whenever we run physical events. So you know who you are. So thank you very much for helping out. And now for the disclaimer. You are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS's opinions. OTCS is office holders, associates, and sponsors are not responsible nor liable for your losses. And OTCS events are for educational purposes only and should not be construed as financial advice. And if you are in doubt, please seek professional help. Now, in tonight's webinar, We will be having a Q&A session at the end of the presentation. If you have questions throughout the webinar, please feel free to type them into the chat box that you see on your screen. If you're using a desktop computer, it will be on the bottom right. And if you're using a mobile device, then you will need to scroll up or down to look for the chat box. So please feel free to type in the questions to Yong, our speaker for tonight, so that at the end of his sharing, I will ask the questions on your behalf. And without further ado, let me now hand over the stage to Yong, who will share with us how to end the year 2022 with these high profit potential setups. So Yong, please.
Okay, good. Cool. I think everything should be working fine.
Yes, I can see and hear you. And now
Right.
we're just waiting for the screen to load and the slide just loaded.
All right. Okay. Thanks. Yep. So thanks, Richard and OTCS for giving me again this opportunity to share what I know. Okay. So today's session, I think as Richard covered as well, we're gonna go through some content that I've prepared. We're gonna dive into some opportunities that I believe would be great opportunities to end off the year. And after that, we'll have the Q&A section, right? So if you have any questions, feel free to type it in first, and then we'll answer those questions at the later part of today's session. Okay, so today's topic over here, what I've prepared to cover with you guys is to dive deep into one of the trading patterns and trading setups, mainly from a technical point of view that I use, almost frequently and on a daily basis. And of course, what are the opportunities that I'm going to share with you are also based on this particular pattern itself from today's sharing. Okay, so quick disclaimer from my side as well. Everything that we cover over here is definitely for educational purposes. And as the title and the content suggests, right, we're looking and sharing with you some of the profitable opportunities to look out for. So make sure you have your proper trading plan, you know your strategy, you know your risk management, okay, before executing those trades. They are not meant to be just blindly followed, yeah? Good. So these are the few pointers that I would cover. And by the end of this session, you'll be able to, number one, establish the directional bias of any technical analysis that you look into. So today's is not just about, what are the pairs or what are the instruments to buy and sell. But more importantly, at the start, I'm going to cover in terms of the skill set, the method that I'm going to share with you to analyze the market. Okay, so one of it is you'll be able to then use this method to establish your directional bias. Directional bias over here for me, it basically means when you look at a chart, you want to very quickly and effectively establish should you be focusing on buying or should you be focusing on selling, or maybe at that point in time, things are not very clear. You want to just maintain a very neutral perspective. Okay, so this is to me what I meant by directional bias, right? So if you're bullish, you want to look for buy opportunity. If you're bearish, you want to look for sell opportunity. So after we establish that, we're going to talk a little bit about Fibonacci's over here to complement and help us identify in terms of entry areas, exit areas, in terms of stop loss, as well as take profits. So I don't just trade off because there's a Fibonacci area or Fibonacci level, but Fibonacci's are very good to establish what we call expectations. And what I mean by expectation is basically As a trader, I will always want to at least anticipate where would the market likely head towards. So I'm using Fibonacci's to give me some kind of guidelines and reference point. Okay, and I'll dive into the complete framework to trade this one pattern. And of course, it's again in trading, I think you guys who have experience, you would know that there's no such thing as like secret. But over here today, what I'm going to share with you more is based on my personal experience and the details of it. Okay, so that you can really take this and evolve it, develop it into your own strategy at the same time. Okay, and last but not least, we're going to definitely talk about the opportunities to look out for to end off this year itself. Okay, so this pattern over here that I'm talking about is called the flag pattern. Again, as I've suggested, it's not something that is kind of like a secret or so. Now, flag pattern, some of you who have more experience in technical analysis would probably also come across it. But what I realize is that a lot of times, if you just search online, touch about flag pattern, flag structure, it may not be very detailed in terms of like how do you know whether a flag pattern is likely going to be completed, in terms of the context of where this pattern develops, where it happens, how do you put all this in place, right? So today we're going to dive into the details of that. Okay, so over here, to trade off this strategy and this pattern itself, I break it down into 4 parts, and I call this a 4-part essentials, and they are essentially step by step, right? So it's kind of like sequential. So the first one, of course, is the ability to identify this pattern first. That's like common sense, right? I mean, if you can't identify the pattern, then there's no second or third or fourth step. Okay, so the first step, which is very important, is you need to have the confidence to say, okay, that's a flag pattern. Now, some of us are probably very systematic trading, which means that we need to be very clear in terms of like exactly in details, how this pattern, what's the definition of this pattern. Some of us are a little bit more visual. So we look at the charts and we can see, okay, the shape of it looks something like that, and therefore that's a flag pattern. Sadly, there is no very systematic way of defining exactly like all the details to kind of define a flag. But we're going to focus a bit more on visual, okay? But it's not that difficult. We're going to look into some of the elements to help you identify this pattern as well. If today, let's say you're very, very new to the flag pattern, okay? We're going to discuss a bit of the concept as well based on Elliott wave theory that builds up into the flag pattern. Okay. Then next is where just now I mentioned this term or keyword core expectations. So to me as a trader, it's very important for me to always have my expectation of the market. Now that's something where I would use words like expectation. I would use words like anticipation. The whole idea is before the market develops, before the market forms a setup, I want to first have the ability to kind of expect it to do something. Okay, and the whole idea of that is so that I can prepare myself going into that potential trade. And expectation over here is basically I want it to happen as how I want it, but the market does not need to give me that. In other words, okay, if today I anticipate a pullback, a retracement, okay, the market to move in a certain way, but let's say in the actual market, it doesn't give me that, then that's perfectly fine, right? So to me, then I don't trade it. I don't take that trade. I don't execute the trade. However, if let's say in a situation where I expect the market to do something and the market did eventually do what I want, then that's the part where I get a trade. Okay, so that's the part on expectation, right? It's not something where 100% is going to happen, but as a trader, it helps me mentally and psychologically because I can then prepare way ahead of the market because I already know what I want to see in order for me to take action. Okay, so today we're going to talk about that as well and share with you some of those principles based on Elliott wave theory, how you can establish the expectations. Okay, and then the third step is where we combine the Fibonacci ratios. fits itself can be quite complex because we have the retracement ratio. We can use Fibonacci as extension. We can use Fibonacci as expansion. Okay. The principles are more or less similar, but how you pull it, how you use the tool can be quite different and sometimes can result in confusion. Okay. So today, again, I will follow accordingly to the time that we have for today, and I'll see if how deep we want to go into this conversation on Fibonacci retracement. Okay, but at least for the basic level, we're going to talk a little bit about retracement, and we're going to talk a little bit about this thing called expansion. Okay, and I'm going to show you how we utilize those to also help us establish expectations. Yeah. And lastly is where we put everything into context. That's where I mentioned, the flag pattern, you don't want to trade all of them, okay? Because you need to also check, does this flag pattern develops around maybe a very significant key level like support resistance? That is also very, very crucial, right? You need to build what we call build a case to execute your trade, okay? So putting things into context is where the fourth part is. And at the end of the day, as you follow through this process, right, you realize that we are establishing our directional bias. We want to focus on buy and sell. We have our expectation, we have our fits to tell us where is our entry point, where is our stops, where are our targets. And then we start to put things into context, and then we ask ourselves this question: is this trade worth taking? Right? So this whole process can answer these questions naturally. Okay. So let's get started with the very first part of identifying the pattern by itself. Okay, I'm going to utilize principles from Elliott wave theory. Some of you who have some exposure to Elliott wave, you'll probably come across it as a lot of like 1, 2, 3, 4, 5, ABC, or WXY, complex correction, and things like that. That's useful to a certain extent, but for today, we're going to utilize just the principles behind all this to help us develop and trade based on this flag pattern, right? So in Elliott wave, we have this term called impulse and correction. When you first start off learning about Elliott wave, you probably hear this and say that, okay, impulse wave are basically 1, 2, 3, 4, 5, right? It comes in 5 waves, and then corrections are basically your ABC and things like that. That's where the confusion can comes in. Okay, so for today, I want to break it down into very, very simple yet easy to use concepts. Okay, impulse over here, we're basically just describing how the market is moving. Correction is the same as well. We are describing how the market is moving. Okay, so don't confuse yourself with all the labeling on Elliott wave. Okay, so impulses are a movement in a market where it's very strong in momentum. Okay, and naturally, if you see some of the major news, right? Like recently, we have the pound sell off, and then earlier this week we have the pound strong recovery as well. Those kind of movements are basically impulses, right? Because they have strong momentum, they move in a very huge momentum. Okay, corrections are basically the opposite. Okay, so corrections are slow. They take away significantly longer time relative to what we call impulses. Okay, and some of the nature and the characteristics of corrections, they're basically range bound, or if you take a look in terms of visual perspective of a chart, they are very wavy in nature. Okay, impulses are like one straight line. Corrections are like up and down, up and down, up and down, right? So I'll show you some of the charts, okay, for now in terms of PowerPoint, and then later when we look at the actual market, where we talk about opportunities, you can look at them again. Okay, so if you take a look at this screenshot here on the PowerPoint, what you see is I've labeled the yellow lines are the impulses, and those that I've boxed up in gray, they are the corrections. Okay, so from this chart here is actually quite visually quite obvious, where impulses are the strong momentum, okay, where the market just basically moves off in one direction without much of a retracement, right? Corrections are basically where the momentum is slower, and if you compare in terms of the duration that it takes to develop, right, the time factor, you realize that correction is also longer, okay, versus let's say the impulses. Or you can take a look at the price magnitude. How much did price move? Impulses are way longer, way more compared to correction. Okay, now this might sound simple, but this understanding itself is actually the essence of, I would say, the building blocks and the essence of Elliott wave principles. Okay, because everything that you build on top later on falls back to this core principle and understanding of impulse and correction. Okay, and of course, this principle here can be used on any charts, whether is it the US stock indices, commodities, FX, or even cryptocurrencies. As long as the market is volatile enough, there is sufficient liquidity to move the market, you can actually use this technical analysis principle. And obviously, it applies to any time frame. Okay, but the lower the time frame you go, naturally things gets a little bit more advanced. It gets a little bit more complex. So if you're fairly new in terms of all these principles, for me, I personally do use it mainly on 4-hour and the daily chart. I seldom go towards like 1 hour or even the 30 minutes. Okay, so that's something to note as well. Okay, so if you take a look at this chart over here, just to give you some example as we walk through, yeah. This is just now, that chart here is actually on Apple on the daily time frame, so you can see impulses and correction. This chart over here that I'm showing you is the euro dollar, which is a FX market, right? It's on the 4-hour chart. Okay, so again, doesn't matter what instrument, doesn't really matter what time frame. You can actually observe this movement, this type of movement in the charts. Okay, so if you take a look at this one here, which I actually boxed up in white, that is what we call an impulse move, right? Because visually, it becomes very obvious that the market came down in a very strong momentum. Then subsequently, we see that the market started to form a little bit of a correction. Because when I start to box up like that, right, I try to draw boxes on the chart, you can actually compare the magnitude versus the duration. Okay, so again, if I go back to this one here, you can see the length of this box is definitely way longer than, you know, the height, right? The height of this box is longer than this. So naturally, this becomes more of a correction as compared to the impulse. Okay, so that's the part where if you want it to be very, very systematic, right? Clear definition, you can come look at this kind of metrics. But if you're a little bit more on the visual perspective person, then I think quite straightforward, right? You just look at how it looks like. Okay, you can see how this market move up as well. Very wavy, right? There's up, down, up, down, up, down. That's the characteristics of correction. Okay, and then subsequently, you can see this move down, I think is quite obvious. It's a very fast move. It's a very strong momentum. So that's an impulse, right? And then after that, we have a big major corrections. And of course, some of you who are more advanced and a little bit more detailed, okay, you might see that within this big correction, this retracement over here, you do get a smaller impulse, a smaller sideways move. You get some small impulses inside it as well. That's the nature of technical analysis, right? We call it fractal nature, which means what you see on the daily, if you go down to the 4-hour, you see a little bit more details. If you go from 4-hour to 1 hour, you see more details. And the principle of impulses and correction can be applied on all time frame. Okay, so that's the part where if you look into the details of it, okay, even within a big correction, you also can find smaller impulse and smaller correction. Okay, and then of course, if you follow through this chart here, the next move is quite clear. Visually, it's fast, it's an impulse, and the last piece here is a correction, right? Oops. The last piece here is a correction. Okay, so I hope this principle of impulse correction is clear. Okay, because while today we focus on one pattern, right? If you actually take this impulse and correction and you start to play around with it as a jigsaw puzzle, right? Mix and match. Where you take, one impulse in one direction, you match it with another piece. You play around with it, you realize that eventually there are only certain number of permutations you're gonna get. Okay, and that's where it starts to become very powerful when you understand impulse and correction, because there are only that few possibility of how the market can eventually piece together. And as a trader, that's where you can start to recognize the repeatability of such pattern. Okay, so today we'll focus on one. Okay, but I just want you to know, when you understand impulse and correction and you start to explore deeper into it, there are other patterns that you can play along with it. Okay, so today we're going to focus on flat pattern because we're going to dive deep, right? Instead of going wide, I want to go deep today. And we're going to talk about the flat pattern. Okay, so flat pattern is essentially where you take two P's, one impulse, one correction, and then you put them together. Okay, and then that forms a pattern called the flat. Okay, so whenever we see a combination of this flat pattern where it's built up from an impulse and a correction put together, we as traders can actually recognize and say that, okay, whenever this pattern develops in the market, there's a certain reliability and repeatability of how this will turn out to be. Okay, it's just like every time if you see, look up at your window and then you see very shady clouds, right? Very dark clouds, then naturally you anticipate, okay, maybe there's going to be a rain. Okay, so it's actually similar kind of concept, right? When we look at flat pattern, then we can anticipate what's likely going to happen next. Okay, so this is the part where when we see a flat, okay, there's a high probability that the market will continue in the direction of that impulse within the flat. Okay, so this helps us to establish what we call a directional bias, which means when I identify a flat pattern, I know I want to focus on a certain direction. It becomes very clear. Okay, and this is where we talk about directional bias. Okay, now I want to just again be clear on this part. Directional bias at this point in time doesn't mean that immediately you jump in and execute the trade, but directional bias just give you that focus point, right? Do you focus on buy or do you focus on sell? Okay, so let's take a look at the visual aspect of how this flat pattern looks like. Okay, so over here, this is actually an example from the dollar index, okay, on a daily scale. So what you can see is from the bottom, we have a first strong impulse followed by a sideways move, which then labeled as correction. And then the next thing that happened is the market then pushed off in the same direction as the previous impulse, right? So that's the part where we talk about whenever we see an impulse plus a correction, which is the flat, we then can establish there's a high probability the next direction will move similar to the previous one. And then after this, you see another impulse, another correction, and then the market just push off again. Okay, so from this example, you can see every time you see a flag, there's a good possibility that it will develop as what we anticipate, right? Naturally, it's not going to be 100% true all the time, but if there's a high chance of happening, that's what we call reliability. And there's a good chance that it keeps develop and keeps happening in the market all the time. That's what we call repeatability, right? So from a technical analysis perspective, what we want is this two: reliability, which is accuracy in a way, and repeatability, which means it happens frequent enough for us to take opportunity of it. Okay, so that's the flat pattern. Let me show you another example in the opposite direction. This is also on the dollar index. Okay, you can see impulse move to the downside, correction, which is the flag. And then what happened next? It came down again. It develops another flag. It comes down again. It develops another flag. It goes down again. Okay, so in this example again here, you can see 4 flags. 1, 2, 3, and then the 4th one down, right? In actual, it's 3, right? 3 flags, but 4 impulses to the downside. Okay, so in this example, it becomes like, oh, 100%, right? Every time you see a flag, it will do according to what we anticipate. But of course, if you trade long enough, that's never gonna be the case, right? At some point in time, some of the flags are not gonna turn out to be what we anticipated. Okay, but the reliability is strong. I would say in terms of accuracy, every time you see a flag, there's a good 60 to 70% chance you will get it right. Okay, in terms of the direction. Okay, in terms of the direction, yeah. Okay, so hopefully so far so good in terms of the visual aspect of identifying the flag. Okay, so what this tell us is that obviously in that two example I show you are things that have already done, right? It's already been established. But when you are trading, naturally you can't wait for everything to be done, and then when it's done and then you see it, you won't have that opportunity anymore. Okay, so what that then tell us is that in the future, if we can see something like that, okay, where we get an impulse move followed by a correction, which is a flag pattern, we can establish a directional bias already. Okay, and that's where the opportunity starts to come in. And in this case, in this example, we'll hold a bullish bias, right? We'll focus on buy opportunity. I'm not interested in the sell, but doesn't mean I buy in straight away. Okay, because we need to build that case, right? We have the expectation, we have the fibs, then we have the context. But whenever I see this, I know, okay, I want to focus on buy. Then I'll zoom in and focus on this particular opportunity, right? That's what it tells me. Similarly, if we have a reverse side of things, right, we have a strong move to the downside followed by correction, then naturally I'll be focusing on sell, okay, because the directional bias is very, very clear. Okay, so that's the first thing you need to be able to take away, right? Which is looking at a chart very, very quickly, identify, do we have a flag, whether is it upside or downside? Do we have a flag? If we have a flag, we have a directional bias that we can focus on. Okay, so same thing over here. Just a quick reminder, you can apply this in any time frame. Okay, so whether you are looking at daily charts for trading, you're looking at 4-hour chart, you're looking at 30-minute chart, 1-hour chart, same principle. Okay, so this hopefully is clear. Okay, now once you are able to visually identify it, that's where you can go the next level deeper, right? You can start to explore a little bit more in terms of like the time element. Okay, in trading, essentially you need to get two things right. One is the direction, you need to get it right. The second thing, you need to get the timing right. Okay, so in terms of like the expectations, the fits, the context, it's actually to help us to build up the case on time element as well. Okay, like now that you already know you want to focus on buying, right? Should you buy now? Should you buy later? Or should you wait for more confirmation? Those are questions that relate back to timing. Okay, so expectations principle helps to give us some guidelines, some frameworks to establish that. So this one here builds in very nicely with Elliott wave principles as well. Okay, so as part of Elliott wave, okay, if you're talking about FX market, it tends to move in a set of three. Okay, of course, if you take this principle and you look at maybe indices, commodities, or the US stock market, the principle of three still applies, but they are not as frequent as FX. Okay, so just bear that in mind as well, right? It's just the nature of the market itself. Okay, but we still apply this principle. As I mentioned, expectations are basically something that you need to have to build your case into your analysis, into your trading plan. It doesn't mean the market needs to follow exactly what you want, but that gives you, the mental prep work. Okay, so we're gonna use this set of trees to apply across all different asset classes. Okay, it's just that if you apply that into stocks or indices or commodities, you're not going to see it so frequent, but you still see it. Okay, so that's what I meant. So the idea over here is whenever we see the market develop completed, okay, a three-wave move, this is where we are anticipating that, okay, the market is likely going to have been completed this one set, and the next move is likely going to be ready to develop. Okay, again, there are more complexity to that, where a tree wave can develop into a bigger tree wave, and then it can develop into even a bigger tree wave. But for today, okay, if you don't really get that yet, it's fine, okay, because that's the fractal nature. But at least today, I want you to take away the principles of tree waves. Okay, then as you practice, as you start to observe a little bit more into the charts, you start to see what we call by fractal nature. Okay, so 1 hour tree wave can build up into maybe eventually a 4 hour tree wave, eventually into a daily tree wave. Yeah. Okay. So what is this tree wave? Okay, so this tree wave over here, if you take a look at this example, okay, we have an impulse, right? We have a correction. So as of now, the direction is very clear, which is what we established in the first step. Okay, we are looking for bearish opportunity. But at the same time, that's where I want to start to look out for, do we have a tree wave expectation completed? And we apply this tree wave expectation in terms of a corrective structure. Okay. Of course, as you progress, as I mentioned, you can get a little bit more complex. You can actually apply that tree wave into impulses as a set. Okay, but for today, we start off with applying this expectation in a corrective structure. So if you take a look at this, right, this correction here is currently still developing, and we have a clear direction to focus, which is to sell. So the next step naturally is to ask, like, where should I be selling it? Is it the best time to sell now? And the tree wave is going to come in to guide us a little bit. Okay? So you take a look at this correction. We currently have a first move to the upside, a second move that's coming down, but we are lacking a third move, right? So you count it in terms of swings in the market, right? The market tends to move up and down, up and down, up and down. So from the lowest point, we see an up move, and then it forms a mini high, and then it came back down and it formed a mini low, right? So at this point in time, we only have two moves. Okay, so as a tree wave expectation principle or guidelines, we would anticipate that the market will go up and form the third move to complete this entire correction. Now, if I don't see that, then it suggests to me maybe the correction is not completed yet. I wouldn't want to be too aggressively selling in, right? So that's where this expectation builds in. Now, the third move, what is the expectation? We expect the market for the third move up to break the first move high point. Okay, so in this case here, this is the yellow line. We expect it to move higher and break that mini high. Okay, it doesn't need to do like that all the time, but as I mentioned, you need to have something that you can reference to. Okay, so as a start, we always expect it to break that high. Okay, so if it just tags it a little bit, like forms a pin and then immediate rejection, that's also what we call break. Okay, so as long as it tags the high. So this is part where we anticipate this move. Okay, so what it means is that I'm gonna wait until I see that happen. Okay, so in the next few moments, the chart starts to develop. We expect it to break this high, and it happens. Okay, so I'm gonna forward it a little bit, and it happens, right? So again, you can see that, right? So this one here is an up move. This is a down move. We anticipate this. Okay, so this next chart here actually shows that this is the up move. This is the second move, which is very, very long. And then you have the third move up, which breaks this high. Okay, and that's the part where we start to see, okay, we have a tree wave completed. Okay, so where is this tree wave? From the bottom, one up, two down, three up that broke that first wave high point. Okay, so this is the part where we have this tree wave completed. We call it one set. Okay, and most of the time when this happens, when we have tree wave completed, the market is ready to move. Okay, you can anticipate that, all right, this correction is likely completed, is done. We can anticipate this move to the downside. Okay, why? Because impulse correction, we expect one more move to the downside. Okay, so this is the tree wave expectation, right? It kind of built in a little bit of the timing factor. Okay, so I would jump now into a little bit on the chart aspect first to kind of share with you a little bit more on that tree wave. Okay, then we'll dive into the fibs. Okay, now I share with you some that you can see over here. Let me erase everything. Okay, it may not be as picture perfect as some of the PowerPoint slides that I've done up. Okay, because in PowerPoint when I'm preparing it, I do my best to find out things that are clear so that you can see it very clearly. But in the actual market, obviously, it's not going to be always like that. Okay, so we're gonna of course look back into some of those that has already happened so that you can visually look at it first, and then today when we go into the opportunities later on, we'll talk about those that are developing still, right? So you can take opportunity of it. So if you take a look at this is on euro dollar. Okay, so we have this strong drop, which is our impulse, and then as the market starts to develop here like that, we start to see, all right, this seems to be forming a little bit of a flag. Okay, but obviously back then, okay, it's not going to be as clear as what we have, when it's done. But you can still see, okay, this is a drop. This one here takes a little bit longer. It looks like it's a correction. Okay, and that's where we can start to anticipate three-wave expectation, right? We can put in that principle. So we have a first move up, we have a second move down. So we anticipate this to go and break the top. Okay, so we want to see that before we can say, okay, this flag is more or less completed because of that 1, 2, 3. Okay, and if you take a look at what happened from there, okay, if I just forward it a little bit, okay, so it took some time, but eventually it kind of tags the high over here, right? So if you take a look at that, it kind of tags that high, and then from there it starts to drop impulsively to the downside. Okay, and that's where you can see that's the flag pattern and the expectation builds in. Okay, now if we forward it a little bit more, okay, we forward it a little bit more. Okay, so we have the impulse. So we wait, right, until we see the pattern of a flag, which means that we need a corrections to develop. Okay, so now at this point in time, it's still falling. So we're just going to keep waiting. All right. So now at this point in time, if I pause it a little bit, we can see that this is already coming back. Okay, obviously it's still too early to say that it's going to be a flag, but this becomes an impulse. We have a retracement starting out. So that's the part where we're going to say, okay, will this eventually turn out into a flag? There is this possibility, right? If we can expect this to come down a little bit, this to go back up a little bit, and then this can form that three wave in a set, and that can be a flag pattern, and then we can take this lower. Okay, so that's where the expectation comes in. Okay, so whether the market is going to develop as how we want it exactly, obviously it's not going to be, right? But that's where we build our case. Okay, so we wait, right? And we see how the market developed from here. It went a little bit higher. It starts to come back down, right? I think this part, if you remember, it basically just chopped around for some time. Okay, so now if I pause it over here, then over here, what we can see is that this is a very strong drop. This one here has a first move up. This one here is a second move down. But if you zoom in and just focus on this, can you also see a flag? Okay, so this is where just now I mentioned about the fractal nature. Okay, so on a lower time frame, you can see an up impulse, a correction here. On a higher time frame, this can be the big impulse, and then if this eventually turn out to be something like that, that can be the big correction. Okay, so this principle, again, you can start to see it in terms of details on the lower time frame. You can also apply it on the higher time frame. Okay, so if let's say today you saw this, okay, on impulse, and then you saw this as a correction, then on a smaller time frame, you'll be anticipating this to happen, right? So because you get an impulse up, a correction, you expect the next move to go up, right? So you can also have that as a possible trade if you're looking at smaller time frame. Okay, so obviously this did not go straight off. It continued to chop around quite a bit, and then eventually it actually came somewhere around there. Okay, if you still remember that chart that we share on the PowerPoint. Okay, yeah, so it came there, and then from there it starts to drop, right? Because then this completed that three wave. Okay, so hopefully that principle, as I establish and share with you, it's clear. Of course, we're going to dive a little bit more into the details as well using fits. How can we anticipate roughly where is it going to end? Okay. But at this point in time, I just want you to see, right? It can come in various sizes, right? This is also a flag here on a smaller scale, maybe on a 1 hour chart. This is also a flag. Okay. So they look similar, but it's never going to be exactly the same. Okay. So that's how it plays out, right? So let's just go all the way back, right? So even all the way until today, you can see this flag played out a little bit, but after that it went back. Then you get another flag, and then this flag played out very nicely. Okay, so hopefully that's clear. Okay, that's where we talk about that three-wave principle. Okay, yeah. Now, once you have established a directional bias, once you have understood the principle of three waves, and you can use that to time the flat pattern completion a little bit better, we were gonna add another element called Fibonacci. Okay, so the easiest and the most straightforward way to use Fibonacci is actually retracement. Okay, so retracement over here, you first need to know, right? It's basically a measuring tool. Okay, there's nothing magical really about it, but some would say because many traders use it, it becomes a self-fulfilling prophecy. Okay, but to me, I don't really doesn't really matter to me. Okay, as long as to a certain extent it works, then it helps you, it benefits you, then you just use it, right? So Fib retracement is basically, as the name suggests, right? Retracement, we are measuring how much the market retraces back after a move. So in this case here, because we are measuring the flag pattern, we are essentially measuring how much the market pulled back after an impulse move. Okay. So when we actually use this, right, there are some key levels that we tend to use it more frequently. This includes like 382, 50%, 618, and 786. Now, to me, 50 and 618 is more of the common fits. Okay. Sometimes the market might react off around 38.2. Sometimes it might go deeper at 786. But most of the time, you're going to see some reaction around 50 and 618. Okay. So that to me is the primary area, 50 and 618. Okay. Now, how we pull it? Right? Because we are measuring the impulse retracement, right? We're gonna pull from the start of the impulse to the end of the impulse. Okay. So this one here, the direction of how we pull it must be helpful to you, right? In a way. So if the market is moving up, we have a strong impulse to the upside. We're gonna pull from the low to the high in the same direction of the move. Okay, and the opposite is true. If the market came down very strong as an impulse, you're going to pull from the high to the low, right? In the direction how you pull. Okay, so case in point example, right? We have this high, we have this low. The market came down very strong. We start to see a little bit of a retracement. We start to anticipate a flag. That's where we can build in all this case, right? So if you have a down move here, the market starts to pull back a little bit. If this develops into a flag, we are going to look for the sell. Okay, and then we can put in, okay, now it's not the time to sell because we only have a little bit of an up move. We want to wait for a three-wave first. Then at the same time, we can utilize the Fibonacci ratios to help us a little bit. Okay, so what we can do is we can actually pull the Fib from swing high to swing low. Then somewhere around the 50 and the 618 becomes our area of focus. We tend to anticipate, all right, the market is going to do a correction towards 50 and 618. Okay, so in this example over here, you can see it does eventually tag the 50%, but obviously it's not like the best looking flag. Okay, but you do see elements of tree move as well. 1, 2, 3, right? It's not the best looking flag, but this is just to illustrate, right? The 50 and the 618 tends to give off some reaction. Okay, so in this case here, you can see impulse. This seems to be a little bit of a correction, a react around 50 and 618. Okay, later I'll share with you some examples on the chart as well. But for now, PPT first, yeah. Over here, same thing, right? It's just the opposite direction. we get a very strong move up. We have a little bit of a retracement starting. We can pull in our fib. We expect the 50 and the 618. And this is how the market developed. Again, not the best flag pattern. These are trades that I would not take it because they don't look very nice. But it's mainly to just illustrate that 50 and 618 tends to give the market some little reaction. Okay, so it's not a magical number. Just be aware that most of the time the market is going to react off that 50 and 618. Okay, so okay, maybe I'll share this first, then we'll go into the chart. Okay, so what's the expectation over here is that we always expect the market to pull back or retrace towards 50 and 618. Now, this is the part where a lot of traders then only take this piece of information and say, oh, I'm going to buy at 50 and 618, right? Every 50 and 618 retracement, they're going to buy it or they're going to sell it. You don't want to do that, okay? Expectation over here basically, as I suggest, right? We anticipate the market is going to do that, but we also want to not forget the primary part is it needs to look like a flag. It needs to be a correction. Okay, so if the market goes up very strong, you pull a fib and then it comes down very strong towards 50 and 618, that's not a correction. That's basically an impulse followed by another impulse. Then you do not want to buy at the 50 and 618. Okay, so bear in mind when I talk about this, a lot of times traders would just say, oh, okay, 50 and 618 becomes my buy area. Okay, it's not, okay, because you need to not forget, previously we mentioned impulse correction. Okay, the visual perspective of the pattern is important. Okay, so bear that in mind. Yeah, remember that. So over here is where we expect a little bit of a reaction around that zone. Okay, especially if it's coming down in a very corrective manner. Okay, so this is a more classic example, right? Ideal example. We have this impulse push. We have this coming down. It's taking relatively longer. We have the 50% Fibonacci. We have a 3-wave move. Very nice. And if you are familiar with channeling, okay, you can draw in a channel. And you can see this is like ideal, right? You have 3-wave. You have the price reacting around the channel, the top of the channel, the bottom of the channel. You have that fits at the 50%. This is like all stars are aligned. Okay. Then, of course, this is the buy example where you can take the trade to the upside. You can look for an entry around that 50, okay, because of how this is coming down very, very nice. You have a lot of factors confluencing it. Okay, naturally, you, of course, can put a buy entry at 50%, right, given that you have all these confluences, right? Later, I'll talk a little bit more about entry point as we go into the opportunity segment. Okay, but for now, we're still building up that whole analysis process. Yeah, so that's one example. Okay, so if I bring you to the chart over here to talk a little bit about fibs, okay, I'm just gonna use back the same chart, okay, which is euro dollar over here. Okay, to walk you through a little bit, right? So from just now at the start, we talked about this drop and then this correction. If I'm going to pull that retracement, right, from the top to the bottom, you can see that reaction around the 50 and 618. Okay, then the next one over here is this. So we have this high to the bottom. Okay, so you can see again around that 50 and 618. Okay, and then this one here, you have a drop. Okay, and then over here again 50 and 618. Okay, again, it's not perfect all the time, but you see that there is that high possibility. Okay, if we, let's say, just randomly take another one, maybe gold, okay, commodities, right? The principle is more or less there as well. Okay, but let's see if we can find a very clear impulse and correction. Okay, maybe you start from the top here, right? So we have this impulse down. This one here, very nice, 50 and 618. This one here, I doubt we have that 50. Okay, we didn't really touch that. Okay, this one here, we do have that reaction around 618. Okay, if you zoom in a little bit, right, and you start to look into the details of it, maybe on a smaller time frame, you can see all the retracement has that very nice relationship with the fibs, right? So all the 50 and 618 is building up. This one here, I don't think you have that. This one doesn't have it. Okay, but you can see, right? Just want to very quickly show you most of the time when we have a tiny bit of retracement or a flag, it tends to come towards that zone. Okay, this is over here, right? This portion here is also a flag, but obviously this one did not come to the 50%. Okay, so the part is not a magic thing. It's not something that it must do. Okay, it's just that as a trader, we have some guidelines to tell us where is our focus. Okay, hopefully that clarifies it. Okay, so that's the Fibonacci retracement. Before we jump into the context part, I'll talk a little bit about a extension. Okay, let me go to pound dollar. Okay, I'm going to drop into a lower time frame to explain and talk about this principle. Okay, this one here, I'll talk about it from an angle where it has completed, so it becomes easy for me to illustrate that principle first. Okay, so if you go back a little bit, not too far back. Okay, okay, over here. Okay, let's just go back a little bit, like earlier this week. Okay, this is the part where you start to see we have the low, we have this strong move up, okay, and then the market starts to pull back, but you can see it's corrective in nature, right? So that's where we start to identify, oh, a flag is developing. The direction is what? Upside, okay? Then we can build in the expectation, right? What's the expectation? Is we're going to expect 1, 2, 3. Okay, and we want to expect that the market is going to break this to complete the flag. Okay, so that's the 3-wave expectation. We can then also simply add in very quickly the Fibonacci retracement first, right? Somewhere around that 50 and 618, which in this case somewhere around there. If I mentioned, you're familiar with channeling technique, you can add in a channel as well to see if it helps. Okay, but to me, not a primary analysis, right? Channeling is like additional factor, but it doesn't really become like, if it doesn't have it, I don't trade, or you have it, that I definitely trade. No, it's additional confluence. And over here, I just want to talk a little bit about extension. Okay, so what does this Fibonacci extension tool does is it helps you to measure the principle of what we call equal leg. Okay, now equal leg means that today if I want to measure this move down, okay, and I want to take this magnitude and I want to map it from this high here. I want to know where will it complete, if it's going to be equal in length. Okay, so that's what we call equal leg. So I can actually, I can visually take a drawing of a box and then map it. I can do that. Or I can use my Fibonacci extension. I can take my initial point that I want to measure to the end point that I want to take reference. Okay, so this becomes my magnitude. And then I pull it to where I want it to start measuring again, right? So let me remove that retracement first. So in this case here, if you look at this, we have the 100%. What this means is that if I were to take, okay, this move, the magnitude of it, and if I were to duplicate that and put it down here, you can see it's equal, right? So that's what the 100% means. So most of the time when we talk about 3-wave expectation, and if we use a little bit of Fib extension, we expect that to come down towards 100%. Okay, so we expect this to come here. Okay, again, it's not that the market needs to do it, but that's our expectation of it. Okay, So if we play out a little bit on this to see how the market eventually developed, okay, so you can see it came down very nicely, tags it, and it bounced, right? And from here, if you look at the channeling technique, right, you gotta have this, but it didn't really come down to the bottom of the channel. But this is also what we call a flag, right? Because you can see impulse, correction, and in the three wave done, we have the fit done, and then the next move, the market just hits off very impulsively. Okay, this is the recent impulse correction flag that plays out very, very nice in this week itself on pound dollar. Okay, so this gives me the opportunity to talk about this principle of Fibonacci extension. Okay, if you don't use the extension, right, if you just use the correct the retracement, it works as well, right? So in this case, you can see around that 618. Okay, so that is something for you to know. Okay, so hopefully it's clear, yeah. So with that, let's put things into context, right? So what we have so far, to help you recap a little bit, we talk about identifying the pattern from a visual perspective, right? Through impulse and correction, you want to identify a flag, and then we talk about the expectation of it, okay, using the three wave expectation, okay? And then we talk a little bit about fits to help us combine that three wave with a little bit of Fibonacci retracement and extension to identify where will this pattern likely end. Okay, you might, if you have a little bit of experience, you might start to see how you can put in your entry stops and things like that. But we'll talk a lot about entries in a while. Okay, but so far these are what things we covered. Then the next stage is we're gonna put things into context, right? Because if today we have established the direction, we have established, okay, roughly where this pattern is going to complete, roughly where we can start to look for trade. The last step is to ask this question, is it worth taking? Okay. Now, this question actually has two components to it. The first component is in terms of the reward. Okay. Is it worth taking, right? So if today you want to take a trade, but the profit potential is maybe only a little bit, you might then want to second, think about it first, right? Because it's not that great. The other aspect, the other element of whether is it worth it or not is about probability, right? This is where you start to add different layers of analysis into it to see if you can increase your probability of winning. Okay, so simple concepts like support and resistance comes in, significant high and low, or if let's say you have your own way of analyzing charts, some of you look at maybe supply demand, some of you might look into volume profile, market profile, things like that. Okay, so you basically add more elements to complement. Okay, that's where the putting into context is. Okay, so for me, we categorize a trade setup, a trade opportunity into three different types. Okay, the first type here is what we call high probability, take it all the time kind of trade. Okay, it means that the profit potential is huge, the probability is there. Okay, I don't really care if that particular trade is going to end up winning or losing, but I'll take it whenever I see a setup like that. Okay, based on the context. Okay, we'll talk about what builds up the context. But at the end goal here is you need to be clear the grading of your trade, right? Is this a grade A trade? Is it a grade B trade? Or is it a grade C trade? Kind of sort of the idea. Okay. Then the second category is acceptable. It's a decent trade, but maybe a little bit risky or a little bit more aggressive. Okay. So for example, like just now, I shared with you the example of pound dollar. Is an acceptable, decent trade. Okay, because it's a lower time frame to me. It's not a usual time frame. We are actually trading a counter trend. So that's what I put it as an acceptable, right? Fairly decent, but it's not something that I will always take it. Okay. And then of course you have the last one over here is valid but short term. Okay. So these are more like the risk reward maybe is max at best 1:1, which means you risk $100, you are potentially only going to make about $100, right? So it's valid because the probability of a flag would still play out, but it may not be something very interesting. Okay, so this is how I categorize things. Okay, so putting things into context helped me to kind of grade my trade, right? To help me determine how much I want to risk. Do I want to look at it? Should I take it, right? If let's say that week, nothing else already, okay, I might focus a little bit on like acceptable trades, right? But if that week I have solid opportunity like grade A, high probability, take it all the time, I would then ignore those acceptable one and I'll channel my focus to those that are higher in probability. Okay, so I think hopefully that makes sense as well, right? So what are some of the elements to help us to put things into context? Okay, this is the part where I want you to know, not all flags are the same. Now they look similar, but where they happen, how they happen, is the differentiation of it. Okay, so a flag that is developing near a support and a flag that's developing at the middle of a chart, there's no context, is very different. Okay, so you need to build up that case. Okay, so this is where we say where. Okay, so the first few parts of how we walk through is how the market is developing, right? Then we have the answer of, okay, it looks like a flag. So that's the answer of how. Okay, and then this part here I'm putting into context is answering the question of where is this flag happening. Okay, so as some of you probably see join in some of my various sharing, right? You always hear me ask this question or share with you guys this question. How is the market developing? Where is this pattern developing, right? So it's about how and where. That puts in that context. Okay, so the whole idea again is, as I mentioned, you just want to add more elements to it. You can use basic principle of support resistance. You can use indicators, really up to individual. Okay, so if you take a look at some example over here first, look at this chart. Okay, we obviously have a visual flag, right? We have a three-wave expectation done as well. We have that channel, very nice. The direction is down. Okay, however, if you take a look at this sell trade opportunity, is what I consider as maybe a valid, not very exciting kind of trade, right? Why? It's because if you're gonna sell it, you're selling it into a near support at the bottom, right? Okay, we're already very, very near to the support. So if you're going to sell this trade, naturally your target is going to be at that key level. And the assessment of, risk to reward ratio may not be that exciting. Okay, so then to me, these are what we call a valid trade. You might be able to take it, but if you have better ones, I would focus on the better ones. Okay, so these are example of context. Take a look at this as well. Okay, so we have a bullish impulse. We have a correction here. The direction is quite clear. We are looking for upside. However, where is this pattern developing? Okay, this pattern is actually developing at what we call no man's land. Why? It's not really at a significant support. This one here, yes, is a key high. Not really a very significant resistance as well, but we're basically in the middle of the entire chart perhaps, and we have a valid setup. Okay, you have a flag, it's suggesting upside, it's a decent. Okay, there's still that probability you're gonna make money, but that's about it, right? You don't have any other elements and factors to complement it. Okay, so this is what we call like decent, right? You can still take it. Risk reward, you might still get like 1:1.5, 1:2. Okay, still okay. And then we look at something that's better. Now take a look at this, right? We have a very, very big corrective structure. We have the big impulse drop, so the direction is down. And in this example here, you can see the market is currently there. And if we are targeting all the way back to the previous low, that move is huge, right? The gray out box is basically the potential profit you can capitalize on. Okay, so this kind of trade, essentially I categorize them as you definitely want to keep an eye on it because the move that you can capitalize is huge. Okay, and today those opportunities that I'm going to share with you to end off this year, they are all in this category. Okay, because if you're looking at longer term, right, like a quarter, you definitely want to look out for trade opportunities where there is significant move that you can capitalize on. Okay, so this is where again you can see they are all flags. Okay, but the context of how it's developing and where is it developing, it kind of makes a little bit of a difference. Okay, so hopefully that clears off, right? If I were to bring you to some of the recent contexts, okay, we do have gold over here. We can talk a little bit about. Okay, let me bring this up. Okay, okay, we need to go back a little bit so I can explain to you the context. Okay, now, okay, the chart is not really loading, or okay, okay. Now, if you take a look, like obviously gold has broken below this level, okay, but before it happens, before it broke below 1680, can you see 1680 is actually on a daily scale quite a significant support, right? Quite a significant support. So naturally you don't expect it to break until the market breaks it. Okay, so what this means is that if I were to go back to this part here, okay, this part here, so this is on the daily, right? So back then, on early September, okay, it hasn't broke 1680. We are expecting 1680 to what? Act as a support. Okay, so on a 4 hour time frame, back then we have a pretty decent flag. Can you see that? Right, so this is what we call the flag. Okay, we have this drop, we have this flag, so naturally you expect this to drop, right? But back then I wouldn't be focusing on the sell. It's a valid one, but personally, I won't be. Why? Because this to me is not something very exciting. Okay. But can you sell it? Yes, it's a valid trade, right? You have all the patterns, you have the expectation built in, you pull in the fibs, you have it there. Okay. Everything is in line. It's just the context. Okay. So there are some traders who still trade it if they're fine with it. Okay. But for me, I did not. The market did drop, right? The market did drop, right? So if you take a look at it, it actually went down as an impulse, very nice as well, and it breaks through 1680. Okay, so if I didn't take it, I miss out on that trade, but it's fine, right? That's my plan. But some traders who took it from a valid trade, it becomes a pretty nice trade. Okay, but of course, this time it broke. But what happens if it bounced, right? You need to then take partial profits or take profits there, shift your stop, break even, etc. And then it becomes, okay, a good trade, but maybe not very, very huge profit, right? But as we start to progress a little bit more, right? So continue on. It broke 1680. And what's next? What I started to see, okay, it broke 1680 and now it's developing another flag. Now the context has shifted, okay? Previously, the flag, where is it developing? It's developing above the support and we are selling into support. Not a good idea to me. But now it has broke support and is doing a flag below the support and we are looking to sell. Okay, so that to me, on context perspective, is great. Okay, so that's where I did not take this trade, but we took the second flag over here. Obviously, it's not a huge trade as well because from a macro perspective, which I'm gonna share with you later on, a little bit more. Okay, gold on the bigger scale, bigger scheme of things, we're actually more bullish on it. Okay, but this on the 4 hour scale is a trade that to me, I'll take it because there's really no downside, right? And there is that possibility it can just keep going down. Okay, so that's why I'm willing to take it in terms of the context where it has broken support and the flag is developing below it, right? So we can't get that drop. But of course, recently it kind of instantly reversed back, right? So this trade we kind of took profits off the table, and then right now we are here. Okay, we're here, right? So that's, I think, the most recent example that I can talk about context, and it's very clear, okay? Because that whole thought process is how I apply it in the actual market back then. Okay, so hopefully you can see that. Okay, hopefully clear. So that's the part on context. Okay, so next part over here, I'm going to talk a little bit about the profit potential that I'm looking out for the remaining of this year. Naturally, these are not just the only trades that I'm looking at, but these are the profit potential that are huge. Okay, I do take some shorter term trades as well, as just I mentioned, like gold, even that I take it, but these are more of the bigger move potential, right? Okay, so I just want you to know, these are not the only trade you have, but these are more of the trades that you naturally want to pay a little bit more attention. Okay, I'm gonna list out all, and then we're gonna jump into the charts today, and then I'm gonna walk you through that application that we have talked about, and the reason, okay, a bit on the rationale as to why I'm looking at them. Okay, so I'm gonna list all of them first. They have a good mix of commodities, currencies, and crypto. Very naturally, there's no stocks. Cause right, 2022 equities are down. I don't think next year equities are gonna bounce. The part over here where I track on equities is a lot on the interest rate, right? So that's the macro perspective of things. There is this study, just to share with you if you're not aware, there's this study that says, when inflation hits so high, the only time the Fed is going to stop hiking, okay, is when inflation matches the interest rate. Okay, so put it into context, right? Right now, interest is about what? Close to 3. Inflation is still at 8 and 9. Okay, so there's still that gap. Okay, so what that study suggests is that the Fed is just going to keep hiking until inflation comes down and it matches. And then that's where the interest rate is going to peak. Okay, and then it's going to cut again. Okay, and from a macro perspective, as long as the Fed is hiking rate, is going to hurt equities. Okay, so if we take these two studies and put them together, then we know, oh, the Fed is still going to hike it, and therefore equities are still going to drop. Okay, so when is the best time to come back to equities market and really focus on it? If you're kind of like really into equities, is the time where you start to observe inflation and interest rate can match each other. Okay, it can be inflation suddenly drops a lot to match back to interest rate, right? So it's not going to be like proportionate like that. It can be like this. Then it also means that the Fed probably would have peaked in its interest rate. Okay, so hopefully you get what I mean. So for me, obviously the profit potential that we're focusing right now that has opportunities are going to be on gold and silver. Why I put them together is because they're more or less correlated. So they quite similar. Okay, the pattern looks similar as well. Then I have Aussie yen and Canadian yen. They look quite similar as well. So I put them together. And then we have the Aussie franc. And then we have Matic, right? Matic is basically in the crypto sphere. Okay, all of this has the pattern that we talk about, has the principles that we talk about, has the fits that we talk about today, has the context as well, but they're on different time frame. Okay, so we'll look into that. Okay, so just want to list now all, and then we're gonna go into it. Okay, so let's talk about gold first. Okay, I think I forgot to add that in. Never mind. We'll take a look at this chart here. Gold. Okay, now gold chart over here, I will bring you all the way to the weekly scale first to look at this chart. Okay, obviously today's sharing on these opportunities are all on very technical perspective. Okay, but if you're interested in gold, later I'll share with you a little bit more as well, because recently in KL, I did a workshop session to just talk about gold. there are different elements to study gold, right? So we talk about macro perspective also for gold market. We talk about some of the sentiment aspect of analyzing gold, and then of course the technical. Okay, so today we focus on technical. Okay, but just to also let you know, the macro as well as the sentiment both suggest that commodities like gold and silver can rally. Okay, so that side, if you are, if you trust me, not me, but my method of analysis, then that two elements suggest upside. And then on technical, that's where we look at it today. Now, on a weekly scale, we obviously can see this one here, a little bit of a flag, okay? Sideways, or at least a very obvious correction, okay? And then this is where the impulse is. We have that three-wave expectation done, okay? If I were to put in the fib extension, we have that fib extension done as well. We are in that zone. So in a way, all of this are done, right? The pattern is there, the three-wave expectation is there, the Fibonacci is there, okay? Obviously, we won't execute a trade on a weekly scale, but this scale suggests that this correction, this flag may have completed, and this can happen. Okay, may, right? May, it's not 100%. So that's the part where we can now, really look into this and say, all right, if this were to rally, then the first potential target that I might have on this scale is going to be somewhere around 2070, right? So that immediately tells me, oh, the profit potential is huge, because if this were to rally all the way from somewhere around 1600, that's about $400, right? And that's going to be a huge potential that we can capitalize on. Okay, and that's where we start to build down into maybe if you want to go daily, going into 4-hour, etc. Okay, so daily over here, we do have a little bit of a three wave as well. Okay, but this one here might be a little bit more advanced. Okay, so first you can see here we have this as a 1, 2, 3, very nice fibs. Okay, and then this one here move off a little bit, and then what we have is another one here, 1, 2, 3. It came down very nicely here as well. Okay, and what we have is a 1, 2, 3. Okay, so within this we have a smaller 1, 2, 3. Within this we have a smaller 1, 2, 3. And then overall we have the bigger 1, 2, 3. Okay, and of course, right, the bigger 1, 2, 3, the fibs can play off pretty neat as well. Okay, almost did not really touch, but the idea is there, right? So this suggests that, okay, maybe from here, can we start to see the bounce? Okay, because on the weekly scale we have built in that case, and then on the daily we start to see, okay, three wave, everything is in. Of course, we can add in a bit of different technical analysis. We have this very nice little downtrend line. The market is still below it, so any buy, you need to be careful. It's a little bit aggressive, okay, but at the same time, what we're trying to do here is, can we catch, close the bottom and then capitalize as much as we can? And this is where the thought process comes, right? It starts to build in all this context. And then on a 4-hour time frame, okay, what we have is, if you take reference to the recent bottom here, we have a pretty strong upside. Okay, this one here, we can categorize it as an impulse. Okay, so what we need now for a buy opportunity is for it to develop into a flag, right? So just now we went like almost an hour plus to talk about the flag pattern. So you should know what we mean by if you want to wait for a flag. Okay, so not only the visual needs to look like a flag, you need to see the expectation there. You can use a fib retracement to give you a little bit of a guidance around 15618. Okay, the visual of it, the three wave expectation, the fib expectation, then you can start to look for a trade. Now this is where I'm going to dive a little bit into like ideas on how you can execute in terms of entry, stop loss, and etc. Okay, now generally I have two types of entry. One is what I call a retracement entry, which means it's a little bit more aggressive. You're going to look to place pending orders at fibs retracement. Your stops naturally goes below there, and your target on this case here is all the way up, right? So your entry can look something like 50%, stop loss below here, your target is at the top, right? But you need to then also time your placement of pending order a little bit better as well, right? I wouldn't place a pending order now. Okay, why? Simply because I haven't seen a clear tree wave. Okay, the market can do what? Let me erase my drawing first, right? Okay, the market can just decide and say, oh, I'm not going to do a correction, I'm going to do an impulse down. Then if that happens, I don't want to be buying there. Okay, so the understanding that correction is slow means that this is going to take time, and you have time. So don't rush into placing that pending order, right? Maybe on the forward scale, you give it like, today's Friday, so you give it like maybe Monday, Tuesday, then Wednesday you come back. If it develops into this flag, starting to show a little bit of a corrective structure, then yeah, you can consider place that pending order there. Can follow me, right? Okay, now that's a bit more aggressive. Okay, retracement entry, you look at a 50 and 618, and then you stop loss below it. The more conservative approach, which most of the time I use that, is I wait for it to form a flag. So we have that tree wave expectation, we have the fib expectation, we have this here drawing, looking like a flag. Then as it develops like that, I will put a breakout above this recent small high, my stop loss just below the recent low, and then my target at the top. Okay, so the breakout is a little bit more conservative because you are waiting to see if the flag did indeed develop. Okay, and then you are waiting for the confirmation of the upside before you execute the trade, because what can happen is this can just develop like that, right? So if you have a breakout trade, then you won't execute it, you won't be worried about it. Okay, every entry technique has its strengths and weaknesses, right? You need to go and figure which one fits you. Okay, so these are the two ways that I use to execute, either a retracement or a breakout. Okay, most of the time I use a breakout, but at times I feel that, whoa, that's a very, very solid trade. I would still use a retracement. Okay, that's how I do it. That's my style. Okay, so you realize, well, the entry is simple. Yes, that's very true. Okay, but in order for us to arrive to the part where we decide to execute the trade, you realize that actually the majority, the bulk of work is through the analysis process, right? Because the execution is actually not that tough. Once you build up sufficiently in your case, you're very clear in the direction, you're very clear in, where you want to get involved in it. The execution is really not that complex. Okay, so this is on a goal. Definitely you want to focus on it for the remaining part of this year. And then silver here, I'll probably not going to dive too much into it because they're more or less quite similar. Okay, so over here, what we have is this is a 1, 2, 3. We have this big move here that looks pretty corrective in relation to this. Okay, from a technical point of view, and then from a macro perspective, this one here I just shared with you, right? But basically, the US side is focusing a lot on solar / green tech. Okay, and the development of solar requires the photovoltaic cell. Okay, and to build photovoltaic cells, the raw materials, one of it required is basically silver. Okay, so it's actually more of like understanding from a top down. And we are still at the very early stage of solar and green tech, right? And why suddenly government starts to push on this is really because, again, back to Russia, Ukraine. Previously, the source of energy is quite available, right? It's easy until we have this crisis, this war. Then suddenly everyone panics and say, whoa, okay, what if suddenly, there's a sudden cutoff of this energy or this resource, okay? That's where they then starts to develop and focus, right? Shift their emphasis towards a little bit more on the solar and green tech, okay? So it's still at a very early stage. But as we start to go into maybe transit into full adoption, that's where the production will be ramped up, right? It's just like how we know that technology is eventually going to be part of our lives, right? But you realize that the true adoption is really forced by external factors. Like without COVID, honestly, how many of us would be doing Zoom calls, webinars? Probably not a lot, okay? But you realize, nowadays everyone is doing it, everyone's comfortable with it, okay? It's really because of an external event forces the adoption of it, okay? So green and solar tech is something that is being forced as well because of the Russia-Ukraine crisis, okay? If there's another war that causes all this, it might, really expedite this adoption. And when that happens, again, the demand for raw materials is going to shoot up, and that would drag price higher. Okay, so that's the macro perspective of that, and that's the reason why I'm also looking at it. Okay, it's not just purely on the technical point of view, but obviously the technical is also building the case. So if you take a look at this on silver, the daily might not have a very nice setup, but the 4-hour might give you a little bit. It's not maybe as nice as gold, but this again has a little bit of a three-wave expectation. This bottom has yet to be broken. So what we can see is this is relatively an impulse. This is the three-wave move. And this little bottom here, we have the first impulse push. Okay, so it's actually almost the same principle as gold. The idea here is as long as the market maintains above this recent low, if you can get a corrective pullback towards 50 and 618 zone, we can expect this to go up. Okay, so back to the weekly scale, silver over here, as I mentioned, based on like huge macro factors as well, you can actually take this all the way back towards like $28.70, right? Right now we are trading around like $18.90 or $19. That's almost like another $10 upside. Okay, it's huge. Okay, so that's another reason why I'm looking at silver. Cool. So commodities, gold and silver, I think that's where you want to keep an eye on. And then we have the Aussie yen and the CAD yen. Okay, so this one doesn't need to go all the way until so high in terms of time frame, but we can look at it from a daily perspective. Now, today we did not manage to go through this other pattern, but this pattern here, if you're familiar with technical analysis, is called diagonal. I just call it a crawl. It's also built up of impulse and correction, right? So this one here is basically a big correction, and then this is an impulse. Okay, so again, it's back to the foundation and principle of impulse correction as well. This pattern suggests a potential reversal. Okay, and most of the time, this pattern would suggest that the market will come back and retest this bottom over here, which is around 87.3. Okay, and this level here, we have a little bit of a previous area as well. So if you take a look, the zone, let me just draw that in as well, right? So you have like the zone here. Okay, so that's huge downside, right? Because this is already on a daily scale. Now I trade mainly on a 4-hour, so this becomes quite interesting. Okay, because we're trading around like 93.6, and then the downside over here is all the way until somewhere around there, right? So that's about like 600 bits. To me, that's fairly decent. Okay, and of course, we don't just look at the profit potential, but right now, if you go back to the 4-hour chart, we are potentially building into a flag. Okay, so you have this impulse already. So basically what, again, wait for is that three-wave expectation, that fibs, the visual of it, and then context. Where is this flag developing? It's actually developing at the bottom. Where's my drawing? Okay, is developing at the bottom of this diagonal. Okay, so the context, right? So that's why I talk about it. And then we are looking at downside, right? So look out for this. CAD yen, quite similar. Okay, quite similar. We have this. Okay, we have this pattern over here. And then we have this as our potential target. Huge downside, right, on the daily scale. And then on a 4-hour chart, we are seeing a very nice flag at this moment. Okay, in fact, this one I already have a breakout pending order I placed in. Okay, just today it looks something like that. Okay, so I talk about the breakout, right? So this is where I'm utilizing the breakout execution. My target here, obviously, I'm going to take partial profits and manage to trade along the way, but eventually, this is where the final target is going to be. Okay, trading view is getting slower. Over here, right, you can see that's the bottom. So rough measurement of a risk to reward ratio is about 4.3. I round down a little bit, 1:4. Okay, it's still pretty decent. Okay, so this is where you want to keep an eye on the cat yet. Okay. And then we have the Aussie franc. Some Aussie franc. Okay. Aussie franc over here. I bring you to the daily first. Okay. We have this very, very huge pattern. Okay, that looks like that. Okay, very huge because this pattern here, if you look back, is February 2021. Okay, we're almost ending of the year already, so that takes like what, almost an entire year. But you can see how nice this tree wave is, right? 1, 2, 3. Internally, you have that 1, 2, 3, and we are at the bottom of this channel, right? So that's where the context element starts to build in. And then we have this potential tree wave that is done. So we are anticipating this, right? To come back to retest or even breaking new highs to establish this as an impulse correction impulse. Okay. So that's where the opportunity comes, right? And obviously you're not going to get in here immediately, but you can go down to the lower time frame and start to look for the flag. Okay, if you put into context where we talk about wait for the flag, take the upside. I wouldn't know exactly when this is going to develop, but basically this is one of the trade that you want to add it into your watch list. Just take a look at it. If you have a flag, everything still valid, you want to consider to buy trades. Okay. So this one here not so soon, right? But the rest of it, you can see the look of the flag is already developing. So maybe I'll just give you very quickly, some areas to keep an eye on for potential targets. Okay, so you obviously can draw this on your chart as well for reference. You have the daily top, right? So naturally, your first target is going to be somewhere there. Okay, if you can get a flag here, you can buy here. Your target here, I think it's already a lot. Okay, but if you're more ambitious, you can look to wait for a break as well, so you don't take everything off the table. You take partial profits, you manage along the way, you can do skill in, add on position and things like that, and then if it breaks, you just ride further upside. Okay, so this is always different. And then lastly, if you're into crypto, I'm looking at Matic. Okay, I do trade a little bit in crypto side of things. Not a lot, okay, but a little bit. Over here, Matic is presenting a very nice pattern. Okay, in terms of crypto, the pattern may not be as like visually pleasing as like some of the more developed financial instruments, but the principles are the same. Okay, so we kind of have this little daily 1, 2, 3. Are we seeing the bottom over here? Perhaps. Okay, you can go down to the 4-hour chart. But we don't really have an impulse correction yet, right? I mean, we have one impulse correction, but this impulse correction is looking more like that. Okay? So this might still come back down first. So again, all this opportunity doesn't mean that today you can get it, okay? But you want to start looking out for it, because if let's say this does like that, comes down, tag this low, does a V shape up, does a flag here, this is the one that I'm interested in. This one here, I'm not interested in. Okay. Matic, a little bit of the fundamental perspective, not really like the valuation fundamental, but the non-technical reason for me to look at Matic is, you have this like tier 1, tier 2, or first stage, second stage kind of like crypto, right? So this is actually the kind of like actual name or company is like Polygon, right? Matic is like the token that is the name of the token used by this platform called Polygon. Some very basic understanding or introduction to that is we have like Ethereum. We have like grandfather is Bitcoin. Okay, back then like transaction, it takes very long, very pricey, very expensive for transaction. And then you have like the newer part of it being introduced called Ethereum, which is a little bit better, right? But at the same time, it's still like old generation, right? So Polygon or Matic over here, you can see it as like a new gen of crypto. Okay, so kind of that kind of understanding. Okay, so it still can be seen as a potential growth if let's say the demand for the usage of it increases. Okay, but understand that crypto is very speculative, but it's obviously way more upside than like Bitcoin or Ethereum. Okay, the part here is you just look at the price. Okay, Matic is trading at less than $1. In fact, it's like 76 or 80 cents. Okay, now if you are prepared to put in, let's say, I don't know, $5,000, and prepared to lose everything okay, you put in $5,000 or even $10,000. Don't leverage, just buy into it so that you don't get margin call, or you don't get negative. You don't leverage, you buy the actual one using cash. If this thing just turns from 80 cents back to like, you don't need to go like 100x, but basically let's just say it goes back somewhere there, okay, which is about like 1:1. Okay, here, okay, not even all the way there. It goes to like $1.40 to $1.60. You double your investment, right? And it's not even reaching that all-time high yet. Okay, so that's the power of it, because it's still new, to a certain relative new, and the price point is still low. Okay, but that doesn't mean that it cannot go zero. Yeah, just be aware. It's just that the upside can be a little bit more attractive as compared to like Bitcoin and Ethereum, which is already very matured in the crypto scene. Okay, yeah. So those are the few things, okay, that I'm personally keeping a close look at. But as I mentioned just now, these are not the only, because if you do regular trading and things like that, you don't really always just look at high profit potential, right? Sometimes decent profits, we still take the trade. Okay, but because we are covering a longer horizon, right? For the next 3 months to end of the year, these are the few that at this moment is presenting that kind of horizon. Okay, hopefully that helps. Hopefully today's sharing can give you some ideas, some insights. Okay, you take away something. I think that's more important also. Right, so before we go into the Q&A, I'm still keeping track of the time. I think I have about 15 minutes, but I don't mind if we extend as well. But keeping track of time. Okay, so we still have about 15 minutes. Give me another about 5 minutes to very quickly walk through a little bit of the offer over here that I've prepared in collaboration, right? To give some special offer to you guys who attended today's session as well, to share and see if this is something that might help you as well. Okay, so over here I've put together 3 things in one for you guys. Okay, the first one here is, we call it the trading dose analysis. Basically this service over here, okay, every day I do my analysis, and then I put it into a report, and then I share it with the community inside this trading dose premium analysis. Okay, what are some of the instrument that is being covered in the report? It includes the major pairs, right? So not the entire list, there's so many, but I mainly focus on the major pairs like euro dollar, pound dollar, Aussie dollar, dollar CAD, and dollar yen. The major indices and commodities like the dollar index, gold, crude oil, and S&P. Okay, and then I put them into a report, and then I send it out to the email. And then of course, there's also the student portal where they can actually reference back to all the previous analysis. Okay, so this one here, just some screenshots to show you. This is where if you log in, you can see all the different analysis every day. Okay, so if let's say you want to reference back like 2 days ago, last week, what was the analysis, you can simply log in, click on the date, and then you can look at that particular date analysis. Okay, so this is not a signal service because what we cover are basically the direction that I would focus for the day. Some key levels, like just now we talked about Fibonacci, expectations, targets, potential invalidation points, which you can use for your stops. But they are not meant to just simply like trade off, like 50% Fibonacci, then you put your entry there. No. Okay. So it's actually designed to complement traders who already have some sort of trading strategy or trading plan. Okay, and then this analysis basically just give them an additional insights or different perspective of the market to complement them. Okay, so I want to be clear on that because I don't want you to think, oh, this is another signal service. Okay, this one here I haven't put it out to the public, but it's something that I've decided to add in for you guys over here today who attended this session, because that focus a lot on more towards FX and commodities. So this one here is the stock side, right? Mainly the US equities. So what is the method I use for that? Obviously, we have the technical analysis portion, but this year itself, buying stocks is very, very challenging, okay? Because again, as I mentioned, the macro perspective of things. But I know that there are still some traders who prefer who I would say more into stocks. Okay, so this one here is not meant for investing, but it's more for short-term trading, right? So we focus on like up and down, buy and sell. So most of the time we'll use CFDs to trade. So this report focuses on three approach: the macro, the sector, the seasonality, and the technical. Okay, so what we do is we just select the top two outperforming sectors for that week, and then the bottom two underperforming sectors for that week. And then from there, we focus on that 4 sectors, 2 outperforming, 2 underperforming. And then we scan through the seasonality of that sector to filter out companies that have high statistical edge. Okay. And then from there, we use technical analysis to help us identify entry, exit, and the timing factor, whether is it good to enter and things like that, right? So it becomes more like a confirmation factor. Okay, so from a top-down approach. Okay, so again, you have quite similar the back end. You can go in, look at all the reports, and then this is how the report looks like. Okay, again, it's not a signal service. It's a market research report to complement traders who already have a plan, have a strategy. Okay, so as mentioned, like this is this week's one. We have the outperforming sector, which is XLV, XLU. We have the underperforming XLC, XLE. And then within healthcare, those are the stocks that have high statistical edge, and then utilities, etc., and things like that. Okay, so for today, usually if you want to do it a la carte, you can still do that. The trading dose, we are doing it at $7 a month, which is super affordable. That's the objective when I design it. Stocks in focus, we haven't launched it, but that would be putting a price point of $27 because the research work, the software required to run that research is more pricey as well. Therefore, for me to also make it affordable, at the same time, to help me cover a little bit of the cost of all these softwares and the work, that's the price point. Okay, and if you add them both, in the future, if you want to take it, it's 34. But for OTCS, today we decide to do it at 20, right? Less than 20. Okay, and I'm gonna add in the Go workshop for you guys as well. This workshop is actually conducted on an offline event, a physical event in KL. And inside, we basically talk about the different frameworks we use to analyze Go. One of them is technical. Just now, when we talk about Go, I mentioned we look at macro and the sentiment. So those are the two other frameworks that we'll cover inside, right? So that sharing session basically covers the different indicators we use to analyze and track Go. Okay, so that one is included for you guys as well for today's offer. Good. Okay, so that's all from me. Let's open up the remaining time for Q&A, and I'll pass the time back to Richard to see if you guys have any questions for me. Richard, are you there?
Okay, Kayong.
Yep.
Sorry. I stepped away from the desk for a while. Yep. Thanks for your sharing. And right now, I'd like to see if there's any questions from the attendees. Now, if you have any questions for Kayong, can you please type into the chat box? Okay, and you can type into the chat box if you are using the desktop computer. Please type in the chat box on the bottom right, and then if you're using the mobile devices, please type into the chat box by scrolling up and down. Okay, so Kayong,
Yep.
may I? Can you hear me?
Yep.
Yeah. Okay. Sorry. Yeah. So just now, you have already shared with the attendees about the trading those.
Yep.
Yep. Okay. So if you'd like to, while the waiting for the questions to come in, if there is anyone who like to take up Kayong's offer, please scan the QR code on the top left corner, which is the blue color QR code. That's where you can learn more about the premium trading those that Kayong have shared. And if you'd like to take up the offer that Kayong has made available to the attendees, please scan the QR code on the bottom right, the purple QR code. All right. So if you'd like to take up the offer that Kayong has generously offered to our attendees, please scan the QR code on the right. And then if you'd like to find out more about the trading those premium, please scan the QR code on the left. Okay. So while we wait for the attendees to type in the questions, so please go ahead to do the QR code scanning. Okay, so let me see now. Okay, Emmanuel is asking whether there's any potential setup, potential sell setup for Euro Aussie dollar.
Okay. There is, but it's not something that we covered in terms of the patterns today. Um, so yeah, I mean, there are definitely because of time, which I explained, we want to dive deep into one pattern instead of going wide. So in general, for me, for everyone over here, so that you know, in general, for me, I have two main technical patterns that I look to execute trade on. One is what we call the flag pattern, which we went really in details today. The other is I call it a crawl pattern, which you probably heard of me describing that, right? Or in other words, the name for it is also called a diagonal pattern. That's another one that I trade. Okay. And of course, there are some expectations to that as well. There isn't much of a fit to crawl pattern, but there is the wave expectations to that, right? So naturally, this two pattern is where my strategy really focuses on. And I would say the opportunities are more than enough with just this two pattern, right? So that's where to also add on a little bit, you don't really need a lot of patterns or strategies. What you need is probably just like one or two, and then you're very, very comfortable with it, you're familiar with it. And at the same time, this pattern tends to repeat itself frequent enough for you to take trades. Yeah. So Euro odd, there is a potential setup coming in, but it's not, the flat pattern that we talk about today.
Right. Okay, Emmanuel, I hope that answers your question. Now, Angie, you are asking whether there's any replay. Now, because you have missed part of it. Now, the video is recorded, the webinar is recorded, and it is can be found on YouTube. So if any of you feel that you want to revisit what Kayong have shared, please feel free to go to YouTube, search for Wealth and Joy, the channel, and then you will be able to see the video of the webinar being presented there as well. Okay, so let me see. Okay, so there isn't any further questions at the moment. So I think that will be very, very clear on what Kayong has shared regarding the flag pattern. So if you have like to reach out to Kayong, may I know where can attendees find you? If they want to reach out to you or to
Um,
follow you on
all
what
right.
you do.
Yes, speaking of that, just be careful as well, because I think not only in Malaysia but in Singapore, there's a lot of like fake social media accounts, reaching out to people to ask for investment. So today, if you want to follow some of my sharing, some of my works, you want to make sure it's the proper one. Okay, so if you want to do it on Facebook, I do have a Facebook page. The URL is facebook.com/ my full name, Angkar Yong. So that's the actual one. And then on Instagram, if you want to follow that, then it will be instagram.com/ again, my full name. That's the only two accounts that I have, right? So sometimes you see other accounts that use my name, use my profile. Just make sure that you double confirm if that's the actual account. Yeah.
Right. Okay. So it's a Facebook and Instagram.
Yep.
How about YouTube? Are there any YouTube that
Yep. There are also YouTube. So YouTube is just youtube.com/Kayong. So I have a channel over there as well.
right? So Facebook and Instagram is Ang Ka Yong,
Yep.
whereas YouTube is Kayong.
Correct.
Okay, all right. So if you would like to continue to follow Kayong on his work and his sharing online, please make sure you follow the correct official channels. And again, if you would like to learn more about the Trading Dose Premium, you can scan the QR code, the blue color one on the left, or go to the link that you see on the screen, Or if you'd like to take up the bundle offer that Kayong is offering to our attendees, please scan the QR code on the right, the purple one, or go to the link that you see on the screen. Okay, so let me just do a final check. Okay, there's no more question. So Kayong, thanks a lot for your time and your offer for our attendees, and thank you for your sharing. Any last words to share with our attendees?
No. Thanks
Okay.
for inviting me also.
No problem, no problem. So, okay, everyone. So, thank you for your time, and please remember to join the OTCS Telegram channel by searching for Online Traders Club, so that you can be kept posted of our future events. And we are planning for more webinars in the coming month or two. So, with that, thank you for your time, for everyone. Thank you, Kayong, for your sharing, and I'll see you at the next webinar. Bye bye.
Bye bye.